Hello, and welcome to our video on understanding Ray Dalio's all-weather portfolio. In the world of finance and investing, Ray Dalio is a name that commands respect. As the founder of Bridgewater Associates, the largest hedge fund in the world, Dalio has earned a reputation for his deep understanding of the markets and his unique investment strategies. One of the most famous and successful strategies is the all-weather portfolio. The all-weather portfolio has gained significant popularity among investors due to its ability to deliver stable returns in various economic conditions. So, let's dive into the principles behind Ray Dalio's all-weather portfolio and uncover the secrets of its success. At its core, the all-weather portfolio is an investment strategy crafted by Ray Dalio to perform well under different economic environments. It aims to provide investors with a balanced approach to their investments, ensuring that their portfolios can withstand the impact of various economic conditions such as inflation, deflation, economic growth, and economic stagnation. During inflationary periods, when prices rise and the value of money decreases, assets like commodities and inflation-protected securities tend to perform better. Conversely, during deflationary periods, when prices decrease and the economy contracts, assets like long-term government bonds and cash equivalents may provide stability and preserve value. The all-weather portfolio also considers economic growth and stagnation scenarios. During economic growth, assets like equities and corporate bonds typically exhibit strong performance. However, during economic stagnation or recession, these assets may experience volatility. To counterbalance this risk, the portfolio includes assets like high-quality bonds and even gold, which historically has acted as a safe haven during economic downturns. The all-weather portfolio follows a specific asset allocation strategy that is carefully designed to achieve its objectives. Let's take a closer look at the allocation breakdown. The portfolio is allocated as follows: 55% to US bonds, 30% to US stocks, and 15% to hard assets, such as gold and commodities. The 55% allocation to the US bonds acts as a foundational element of the portfolio. Bonds are known for their lower volatility compared to stocks and can act as a hedge against economic downturns. During deflationary periods or economic stagnation, bond prices tend to rise as interest rates fall, providing stability to the portfolio. Additionally, US government bonds are often considered a safe haven during times of market turbulence, attracting investors seeking stability and capital preservation. The 30% allocation to US stocks represents the portfolio's exposure to the equity market and its potential for long-term growth. Stocks historically have the potential to deliver higher returns during periods of economic growth. By including US stocks, the all-weather portfolio aims to participate in the growth of the economy while maintaining diversification across asset classes. The 15% allocation to hard assets, such as gold and commodities, serves as a hedge against inflationary pressures. Gold, known for its historical role as a store of value, tends to perform well during periods of high inflation or economic uncertainty. Commodities, including energy, agriculture, and industrial metals, have the potential to appreciate in value during periods of economic growth when demand for these resources increases. Including hard assets in the portfolio provides diversification and potential protection against certain economic scenarios. The rationale behind this asset allocation is to create a balanced portfolio that can perform well in different economic conditions. By diversifying across bonds, stocks, and hard assets, the all-weather portfolio aims to capture the upside potential of economic growth while also providing stability during deflation, economic stagnation, or periods of inflation. The goal is to achieve stable returns across all economic environments, mitigating the impact of any single economic scenario on the overall portfolio performance. Economic regimes are distinct periods categorized by specific economic conditions. Let's examine how different assets perform in each regime. During periods of rising prices, also known as inflation, assets that have intrinsic value and act as hedges against inflation tend to shine. Two prominent assets in this regime are commodities and gold. Commodities, including energy, agriculture, and industrial metals, benefit from increased demand and rising prices. Gold, historically regarded as a store of value, and a hedge against currency devaluation, becomes an attractive asset during inflationary times. In deflationary environments, when prices are falling, stability and reliable income become essential. Bonds, especially high-quality government bonds, are sought after during deflationary periods. As prices decrease, the fixed interest payments of bonds become relatively more valuable, providing a steady income stream and acting as a safe haven for investors. Bonds, lower volatility compared to stocks, makes them an appealing asset class during deflationary times. During periods of rising economic growth, known as bull markets, stocks tend to flourish. Increasing corporate profits, positive economic indicators, and investor confidence drive stock prices higher. The potential for capital appreciation and dividends makes stocks an attractive investment choice when economic conditions are favorable. In bull markets, investors often allocate a larger portion of their portfolios to equities, willing to take on more risk. In contrast, during periods of falling economic growth, or bear markets, stocks tend to struggle. Uncertainty, declining corporate earnings, and pessimistic sentiment can lead to a decrease in stock prices. During these times, bonds tend to outperform due to their perceived safety and stable income streams. Investors seeking capital preservation and reduced exposure to the stock market often allocate more to bonds during bear markets. While the specific asset allocation of the all-weather portfolio may vary, the principles of diversification and balancing assets to withstand economic scenarios remain consistent. When examining major crises, like the Great Financial Crisis in 2008 and the COVID-19 crash in 2020, the all-weather portfolio has demonstrated its resilience. It provided investors with smaller drawdowns, meaning smaller declines in portfolio value during market stress, compared to traditional portfolios. In high-growth environments characterized by bullish markets, the all-weather portfolio may underperform compared to portfolios with a higher allocation to stocks, such as the S&P 500. This intentional underperformance can be attributed to the portfolio's significant allocation to bonds, which generally have lower returns during periods of strong market performance. However, the primary objective of the all-weather portfolio is not to chase high returns during these periods, but to provide stability across all economic environments. If you're an investor seeking high growth and aggressive returns, the all-weather portfolio may not be the best fit for you. While it aims to provide stable returns, it prioritizes risk management and downside protection over chasing maximum gains during bull markets. Investors with a higher risk tolerance and a desire for potentially higher returns may prefer a more aggressive approach with a larger allocation to equities or growth-orientated strategies. This strategy requires patience and discipline, as it may underperform during periods of high growth and market exuberance. You should be comfortable with potentially sacrificing short-term gains in favor of long-term stability. Investors who obsessively monitor individual positions or have a strong preference for specific asset classes may not fully appreciate the performance of certain assets within the all-weather portfolio. On the other hand, the all-weather portfolio can be particularly attractive for investors who prioritize risk management, capital preservation, and a more balanced approach. Its diversified allocation across multiple asset classes helps mitigate the impact of specific economic conditions on overall performance. Investors with a lower risk tolerance or those approaching retirement may find the all-weather portfolio appealing. Its historically stable returns and smaller drawdowns during market downturns provide a sense of security and confidence. Let's look at the asset categories and some potential ETF options for implementing the all-weather portfolio. US bonds. For exposure to US bonds, consider ETFs that track broad-based bond indices like the Bloomberg Barclays US Aggregate Bond Index. Examples include the iShares Core US Aggregate Bond ETF or the Vanguard Total Bond Market ETF. US stocks. To gain exposure to a broad range of US stocks, look for ETFs that track major indices like the S&P 500. Examples include the SPDR S&P 500 ETF or the iShares Core S&P 500 ETF. Hard assets. When it comes to hard assets, such as commodities and precious metals like gold, consider ETFs that specialize in these areas. For commodities, Explore options like the iShares S&P GSCI Commodity Index Trust. For gold, popular choices include the SPDR Gold Shares ETF or the iShares Gold Trust ETF. Another critical aspect of implementing the all-weather portfolio is periodic rebalancing. Over time, the performance of different asset classes may deviate from the desired proportions. Rebalancing involves selling assets that have outperformed and buying assets that have underperformed, restoring the target allocation. This disciplined approach helps maintain the intended risk profile and allows you to benefit from potential gains in asset classes that have fallen behind. One of the advantages of the all-weather portfolio is its simplicity and ease of implementation. By following the predefined allocation percentages across the asset categories, you can construct and maintain your portfolio without the need for complex strategies or frequent trading. This simplicity allows you to focus on your long-term goals, reducing the need for constant monitoring and adjustments. We explored how different assets tend to perform in rising prices or inflation, falling prices, deflation, rising growth, bull markets, and falling growth, bear markets. By understanding these economic regimes, we can appreciate how the all-weather portfolio's asset mix helps it adapt to different market conditions. The all-weather portfolio offers a balanced and robust approach to investment, prioritizing stability and long-term capital preservation. It may not be suitable for those seeking high growth, but it is an excellent option for investors who value consistency and are willing to take a long-term perspective. Remember, investing involves risk, and it's essential to consult with a financial advisor or conduct thorough research before making any investment decisions. By incorporating the principles of the all-weather portfolio into your investment strategy, you can aim for stability and consistent returns across different economic environments. Thanks for watching, and happy investing. Don't forget to like this video and subscribe to our channel for more valuable insights. Until next time, stay informed and make wise investment choices.